Good night, friends. How we're doing today? My name is William Rodriguez, and Luis as your interpreter. And we're both teachers here in the Academy of the Three Trader Teams. In today's, we're gonna show you and explain to you on how what really happens in the retail world, what really happens in retail trading. And if any other way, and in a moment where it happens to everybody when they start, they lose their money and they don't know why they lost their money and why that happened. And it's simply because they don't have the information, the adequate information for them to be able to analyze the charts and be able to know how the charts are configured and how they really are, how they really work, and how they really work in retail trading world or in the trading world. So right now we're gonna see what type of information you need to know so you could know that you're learning so you know that you're learning something that's going to help you generate profits, be a profitable trader. So we're going to try to teach you how to know what you're going to be saying, trading with, and what information to use. So what do you really need to know, and what type of information do you need to know, and what type of information do you know, and you need to find that could help you educate yourself, educate yourself the correct way. Out in the retail world, there's going to be two groups of people in the trading world. It's going to be the retail world, your retail traders, and those are your small players, your small fish, us, the poor, and the institutional traders. So both sides of these groups, they both have information, and some of them have incorrect information, some have correct information. And in the retail world, normally they use normally you get subjective information. So what is this inject subjective information and why it's important to know what the subjective information and why they're educated with the subjective information. That information that which they use to analyze the charts using they're using indicators, they're using tools like indicators, and inside the charts are going to see support, resistance, trend lines, and figure chartism charts, banners, triangles, flags, certain type of triangles. That's all subjective information. So what does that normally happen with that information that retail traders are using? Just for example, traders are going to start seeing here on top here, they're going to start seeing a resistance, and then price comes and breaks it, and then price comes in, falls, and retested this zone, and it comes in and becomes a support, just because they see this, a lot of traders would like to generate this type of trades, a buy. Just exactly here. And they're just waiting for the price to retest and then for it to go all the way into a buy. And then price just goes and it goes their way at first, and then it just comes down and takes their stop losses. And it goes into takes all the stop losses from the buyers. And then price just keeps going up and up and up. And then the retail traders start thinking, oh, I just have bad luck. But if they would have had it established their stop loss or lower than, or if they would have used a bigger stop loss, they would have won the trade. But they always end up in losses just because they're using subjective information where the context or the subject of the information, and because they think the price always bounces in those resistance or in those trend lines. They always think price is going to bounce there. Oh, here they think they have an uptrend channel, so I must keep buying here because it's going to keep going for a buy. That's all subjective information, because in reality they're not really understanding what the graph is doing, the charts. But in the other side, the big institutional banks are the ones that control the big banks and all that information. And I'm gonna show you how it works. They use they use objective information. You see, retail's use subjective, re institutional use objective. The big institutionals that use this, that are proficient in this business of trading, they're gonna configure the graph, the charts in using an algorithm, a high efficiency algorithm, but they do it in an objective way. So what does that really mean? That if we know that this objective information, that we will be able to have solid information, so we know, that way we have a more understanding of what's going to happen in the charts. Because as you know, the charts just don't move to move. Just how some people in the retail believe. They believe that the charts just move to move, but it's not like that. So this is what we're going to show you in the next step. It's going to show you and define to you what happens between subjective and objectives. So I'm going to go ahead and tell you is that you always have to look for objective information, structured information. That way you could form yourself as a professional trader. So let's start. In this little square here, we're going to start to pretend here that the square here is the real financial world, the financial world that we know it as, your Wall Street, your all those big players out there. And this is where all transactions come from, financial transactions, economic, and this is where all the industries, all everywhere in the retail trade, economic world comes in. So as we know where these transactions happen in the world, in the whole wide world, so their investments are through the financial markets. So everybody that does trading in majority of times think that they're operating they think that they're operating the platform that they're using, MetaTrader 4, MetaTrader 5, Ninja Trading, Thinkorswim, or any platform that you guys see a chart, they think it's a direct information of what's happening in the real financial world. And it's always put it in these platforms. And you have to operate it. And you have to operate it in the context where the price just moves to move. And this is why a lot of traders think there's bears and bulls. They think there's buyers and sellers are the ones that move the market. So if they think, oh, there's more buyers, the market's gonna be an up. But if there's a lot of buyers, a lot of sellers, the price is gonna go down. They start they believe in that information, that old information that you shouldn't be really using. So just in a moment, I just mentioned that the big institutional banks have a high efficiency algorithm that they use in their advantage. When I refer myself as the big institutionals, your commercial banks, the smart money, the market makers, the whales, and who are they? They're your big financial markets, your central banks, and your big hedge funds. And they're the ones that move billions, billions, billions of dollars. Not us who you and there's there's a lot of videos. There's a lot of videos that we have recorded in our Telegram to show you that shows you how this works and how it works in the real world. So check out our Telegram. So in the meanwhile, I'm going to show you how this works. So in this system here, in this high efficiency system, is where the algorithms participate. And they're the high efficiency algorithms, and then they're the ones that the big institutional banks use. So this information here in the financial world, real financial world, it's gonna happen here through against the algorithms, and later it's gonna be graphed in the charts that we're operating. As you can see, it's not a direct trip. It doesn't go in a direct way. So through these algorithms, the big institutional banks have the opportunity for them to configure the charts in their favor. So in our point of view, we start noticing that when we start seeing that the real financial world, it's a big good excuse for us to generate this type of business in trading. So not only is this the only information that the algorithms use in the graphs, it's also the way that the manipulation. So let me tell you that not only the graphs and the charts are not manipulated, just to show you a little more example, that a lot of traders start believing that they could buy here, and they see that here because it broke here and it broke the support, this resistance before, and they think they could generate this buy, and then a lot of them start to buy here, and then here they start generating buys, gains, profit, and they start seeing it in this way, like, oh, price is going up, and a lot of them start seeing trend lines, and they're happy that they're winning, and they stabilize their stop losses from the bottom. They put the stop losses right below the trend line, and they're happy that they're winning. And then price just comes in and takes their stop losses, and then price starts moving again on their direction. And that's the way that people knew the price was gonna go. But they were able to identify this movement. They call it a manipulation. Oh, and they think, oh, what bad luck did I have? That I had that the market just decided to manipulate for me to lose in that moment because we were in a good way making gains. And that's also a bad information. And it's not just about a bad moment of having manipulation. It's also about real complete manipulation because the algorithms already manipulated the charts. So because they wanted you to think that there was already an opportunity to take for you to take some buys. It was just a trap to set you up just to take your stop losses. It's not only manipulation just to show you the whole thing, and it's not casually that the price happens to take out your stop losses. You've probably heard out there the banks they already know where your stop loss is, where you think where the graphs are operating in the real world. So what really happens is that the retail learning world out there is manipulated completely. So because you think where they're watching your charts, so they know where you enter, because it doesn't work that way. No, it's because they already configured your mind with the information that they taught you. So that way you stabilize your stop losses on the levels of the charts on the way that they configure it. So based on the way they configure the charts, they make you think that's where the levels are. And that's where you stabilize your stop losses. And you use the retail information that you learn to put your stop losses there. So as you learn, we want to say that the retail education out there is also manipulated. They do it on purpose to like cheat you those ways. So the retail education out there is manipulated. And the reason why 95% of traders lose their money, all their capital, and end up being bankrupt or burn accounts, and it's because they learned retail information out there. And that information out there makes you believe that you think you're forming yourself professionally and that you think that you're learning, but the only people that's it's working for is for you to think that you're gonna win and you keep on trying like a lottery and you keep on trying, putting more money, but you're always gonna end up losing. That's the honest truth. So even out there, there's a lot of information out there where you always think the books should be able to help you. So there's a lot of books out there and they make it so you look out there that you lose in those books. So they make you think that you're in the right, that you learn something and you're learning something important. So now, oh sorry, the same thing happens in the same platforms in like brokers that have academies, brokers that have they're not gonna generate information so you don't take their money from them. Nobody should use information that the brokers teach you. In the majority of times, brokers are market makers and they benefit from you losing money because they make more money from you losing. Later, for that people that like that free information out there, the free education, the YouTuber, and you could in YouTube, let's be honest, you could do find some information that could work for you, but since you're not professional, you don't know what to pick, what information to pick. But majority of times, 95% of traders don't work for traders. It doesn't help for them to educate themselves. So the education system is very influenced for you to lose. And all that information that you learn, that you taught, is already, the algorithms already know that information. They already learned it. That's why they know where you're gonna put your stop losses, and they already know how you're taking your entries. Later, we have the psychology of the herd, the psychology of the masses, and that's the psychology of the masses implied to the charts, used on the charts on the graphs. Like we said, psychology applied in the graphs on the charts. So how does psychology of the charts work? Psychology of the masses work on the charts. In one of the moments, just to give an example, where you took an entry, you took a buy, when you use retail information later, and you're happy that you're winning because you're winning now. And from that point of view, you, that's where the manipulative psychology of the manipulation happens. Because these algorithms, they're gonna start to make you think, they make you think that you're the best trader out there. They make you think that you're gonna win. And they start to play with your emotions. And here you're happy, you're winning. You're right there when the price hits the price, and then price goes to here, and then boom, retests, and then comes back in. And a lot of traders are getting more buys here. And then price comes in and takes your stop loss. And it comes in really quick. And what happens in that moment? The people that were buying in this price right here, and then able to see this line here, that support here, that they think it's a resistance now. Price comes in and breaks it. They lost their stop. And then the price comes in, pull backs, and gets into the zone again. And what are people gonna think that they lost their sells? They're gonna start to think the price broke this support and it retested it, and then price just starts to fall again. And it starts to fall again. And the traders that were buying, they don't care about winning anymore. They just want to recuperate what they lost. So immediately, without even doubting it, they get into sells. And then it's because the price just broke here and broke support here. And then it goes to support and resistance here. And then it comes here and it gives them the confirmation I got here. And then from here they start saying, oh, good, good, I'm happy. And it's because I'm recuperating what I lost. But then price comes in and tells the same thing, and it takes out their stop loss again. And this happens, and it makes all the traders start to like get desperate, get anxious. Now they don't have one operation and loss. They have two profit loss trades. And just to see that price is moving really fast, and they see that it's moving with high volatility, and that connects with your emotions. And it's because you want to get in, because you want to recuperate those losses, and you're not gonna let the price leave without you. But since the price is moving really fast, and you take a fast reaction, and then you start taking another buy, and then you use what you retail trade you, and you take another buy, and then you put your stop loss from the bottom again, from the lower lows. So supposedly that's gonna help you out. It's gonna take care of you. And then price comes in and takes you on a stop loss again. And then here you have three loss trades, three losses. And this really happens that you start getting sad, depressed, emotional, and you're already very high emotional because you lost two trades. Now you lost three trades, and that just clouds your precision on what's going on in the charts. And you start seeing what's happening, and it's not something that helps you win. And then that moment you start to feel yourself crazy. And then a lot of times, you start to take buys get to try to get buys, and you start losing. And then to the end, and it goes all the way up and it starts to generate a movement and it goes all the way up. And because you lost a lot of times and you're scared to keep operating and you're losing trades and you're sad and then you're sad and you're losing trades and you're negative and you're in losses. And it just normally most of the times you blow your account. These movements here happen a lot and they are generated with moderation because there's a lot of expansion and there's a lot of movements, a lot of pips. And at the same time, at the speed that it moves, it varies because it goes very slow and it goes high and it goes high, fast, slow, fast. And this happens and it's done in purpose to connect with your emotions and it helps you with your emotion. It just controls your emotion. The algorithms are experts in making you feel or making the rate traders feel. And I say it because you feel like you're the boss, you're winning. And I used to use retail. And I know because I have a lot of friends that are traders that they used to feel the same way when they operated that type of information out there, the quick rich schemes. And then you were sad the whole day. And then you're addicted. You want to keep on operating, you want to keep on trading. And that's the history of all days. Operate, trade, overtrade, and trade emotionally. And this time you're just gambling and they're just using information that it's not really good for you. And then you could win at some times, but the price is gonna come back and take everything from you. And lastly, we have the fundamental information. People that use the news to trade. There's a lot of traders out there that use the fundamental trades. They use the fundamental trades to operate. I'm not saying that it's not. I'm not saying that it's not bad to operate when there's a fundamental. But here I'm explaining to you what you need to do know. The fundamentals are gonna give you two types of information out there. The direction of the direction of the price, and it's gonna also give you the impact of the markets out there. And it's all due to the news. So what happens with the theme about direction? There's a lot of web pages out there and a lot of brokers that want to get out there and be able to help you out there. They want to guide you to what's going to happen with this news. They're going to be like, oh, this is what's going to happen. And then they tell you what about the margins happening with the percentage of buys or sells. And it's all due based on the results of the news. And they're going to tell you they tell you if it's from the expected, you're going to generate buys and you're going to do it in certain zones. Or if it's in the bottom of from what expected, and it's you're gonna be like, hey, I'm gonna generate cells. And from out of nowhere, you get the news from the fundamentals. And let me put it in my mind. There's positive news out there. There's good news out there from the news that we were expecting. And then later, markets are gonna do this. They're gonna start moving to the high buy side. They start moving to the uptrend. And later, this interpretation, fundamental interpretation, is not done is casually. It's not casually that there's gonna be confluences there's going to be conflicts with your retail trading, and it all mixes together. And then the news comes out and it tells you that this market is going to go on buys, and it starts going on buys. And then we start seeing here, we see a resistance that becomes support, and the price starts going up. And here I'm going to invent myself that there's a trend line, and in coincidence, and the fundamental analysis that the other broker or the web page gave you goes with your technical analysis, and you're gonna start believing that you could buy, and you're happy, you're generating gains, and then the price gets your stop losses, and the price starts playing with you, and then poof, price just starts going your way. So the information that's out there, the direction that the other web pages offer you doesn't work. I recommend don't use it. It doesn't work for you to trade, because you're gonna end up losing. You're gonna end up losing. You end up blowing accounts. You end up giving up on trading. The only thing that works is to know the impact. Is to know the impact of the market. It just lets you know if that's gonna be a volatile market. So the impact is good to let you know that. Just to give you an example, the ones that operate and we know the objective information. And just to give you an example, in this theoretic example, and it's just what really happens out there a lot, because that's what really happens. So we start looking for price to come exactly, for price to come here and take them stop losses and then take them out where they're generating. Because in history and historic, we know how to be able to recognize objective tools, institutional tools, which in reality, it's in tools that is used against retail traders, but we use it in our favor. So we'll be waiting for to take a trade in this form. So while everybody loses, while we're here waiting for us to put our buys, and we'll be in profit with minimum drawdown. And we know the price is gonna come in and take them out, and it's gonna take out those traders that are in here in liquidity that might be selling. And we know what zone, and we know what probability that the price, and we know with high probability where the price could get there. And we know because of the impact of the news. So just to give you just to give you a summary, the fundamental doesn't help you to know the direction. It just helps you know if that it's going to be a high volatile days, if it's going to move a lot. So as you can see here, and this is what really happens in the financial world, in the trading world out there. The prices don't move just to move. It's just configured, and it's just configured with like 1 hour candles. All the candles is configured. It's done from the 1 minute to the monthly. Everything's configured. There's no candle or wick that happens just to happens. It happens because it really happens. Everything has a reason why. So as you can see here, it's not here that it doesn't deal with what's happening in the retail world out there. It's done. It's because it happens. That's how the world is set up, the trading world. All this information that you've seen here and here, and they form all this information out there, just the whole world of trading. The whole So just in a moment, in the start, just to get back in context, I started I started talking about how a lot of people start trading with subjective and objective ways. We generate operations trades because we are educated and we're educated with objective information. And that objective information is based on and is based on with the knowledge that we know on how the charts are configured based on the algorithms. So what we know here is the closest to know how the markets are configured. But just to be sincere, they don't use the platforms that they use. They don't use the platforms that we use to operate trades. But the tools that we use is the closest things that we use so we can know objective information. So how does this algorithm really work? So how does it really work that high efficiency? And I'm just gonna show you here, and it's 4 steps, huh? And how the algorithms configure the charts. So here we have algorithm. First, first the algorithms, they start, they're gonna start to generate a retail configuration, open retail configuration. We call it that way, open retail information, and we call them the configurations, which is why a lot of traders, retail traders, they used to operate or make their trades. So maybe support, resistance, chartism. I'm just gonna use the same example. So I'm just gonna use the same example so we don't get lost. So here, as a for us is a open retail information. So we know here that there's traders here generating in buys. And later on, so we know where it comes support resistant in the trend line. So the first thing here, we know it's the retail trading. Second, the algorithms, they generate injection of capital. And it's billions of dollars, billions in buy side. And they do it in the zones. And they do it in the zones. So it starts to confirm the retail traders that it's on a buy side. And it just does it so they can start accumulating trades. They start trading, they start buying here, they start buying here. And every time price does a pullback and it goes back, the retail traders are generating more buys and more buys and more buys. And then step number 3, the algorithms, they're gonna start to do a counter trade, a counter of all the trades that's going happening out there from the retail traders. So that means that they're gonna start doing the opposite. So they start to generate sales, and they don't care if the price is going up, and they don't care if their sales are up and they're in losses, because they don't care because they're the ones that are configuring the charts because they know what they're doing. So the ones the ones that are new and don't know what a counter trade is, let me just explain to you really quick. So for you to be able to generate a trade, there has to be buyers and sellers. And as you can see here, there's buyers and there's sellers here. So here, if you buy, somebody has to sell. And if you win your sales and the one that was buying loses, and if you win your buys, the ones that selling loses again. One of the two is going to lose. And that's a counter trade. So as the retail traders are generating buys, the big institutional banks are over here generating buys, sells. And that's step number 3. And with the 4th step, the algorithms start to generate injection of capital, billions and billions and billions of dollars captured so that the price could fall down and fall down completely, and it could come in for the lowest price. So it could come in and get them in stop losses, and it comes here and gets them all in stop losses. So when the price comes in and gets them from the bottom, from the minimums, all these sells, they end up in wins again. So as you can see, the sellers win and the buyers lose. But as you can see, the sales was generated by the big institutional banks. And then they stay with all your money because they're the ones that won. So as you can notice, they configure their charts and they select all the charts and select all the movements out there. And this happens all the time. It happens in the 1 minute, the monthly, and every time frame. It happens in every market, every pair. And then it happens also when the ones that market makers breaks, the ones that they do the synthetic derivatives that they do too. And this happens all the time for everybody. So now, so what else happens is that the business of trading is mainly about is to accumulate traders, to accumulate buyers and sellers in certain zones, and it just makes them lose everybody here. So here, as you can see, there's going to be a lot of buyers in this line. A lot of buyers. Buy here, buy here, buy here. And then over here in this zone too, there's going to be a lot of sellers here too. There's going to be a lot of sellers here in this zone. So even over here. And their stop losses from the buyers are going to be right here. And from the buyers on top of here. And the stop losses is money for the institutional banks. Liquidity. And the big institutional banks like to call it a liquidity. They like to call it liquidity. So in another moment, the algorithms start to do this. They start to fall from the bottom. They take all the stop losses from the ones that were buying, and then price comes in and takes them, and it takes all the stop losses from the people that were selling. So as you can see, it took liquidity from the top and the bottom. But the way that the charts are configured, the price generates this pattern, this objective pattern, and it's called the power of 3, where the price comes in, consolidates, manipulates, and then expands. Or it also does consolidate, expands, and does a reversal, and then it does a pullback. All this is objective, and there's reason behind it, and there's institutional tools behind it, and there's institutional tools right in front of it that we could be able to see, be able to locate in the charts. And as you can see, the business is to accumulate traders and take their stop losses and take their money. And this happens in all the time frames. So we're gonna start seeing this in the charts. Just to give you an example, it's not done. It's not casualty that this happens here where there's a line and they're just generating traders. So what happens here when the price is on buys? A lot of traders are waiting for the price to go all the way to the moon. And then later, some traders that start seeing this here, they start to see this big fall. They're the ones that are gonna start to generate sells. So as you can see in every zone, every there's buyers and sellers in every zone. They generate them. And then what this price does, it comes in, it does a accumulation of traders, manipulates them, takes them out in stop losses, and then boom, comes down and takes them out and takes them out in stop losses. And it takes out the ones that are buying here. And then here we have the consolidation, the manipulation, and the expansion, and the reversal. And then here, as you can see, it did the cycle that I needed to do. This happens in all the time frames, in all the markets, in every one of them. And the same thing happens here. As you can see, price originally comes into this price, it comes down, and it comes back up, and it comes back down. And then as you can see, you have traders here, buyers. As you can see here, it's a trend line, and they start to buy here. And they start to buy here, a lot of them here. And they start buying and they start selling. And they start buying, they start selling. That's a confirmation to start buying or selling. And then price comes in and takes them out in stop losses. And then starts to take the ones that were in stop losses here. And then later here it comes in, and then comes in and takes the stop losses again. And then here in the other time, it comes in and takes them. And it comes in and then does consolidates, manipulates, expands, and then it does a pullback. And as you can see here, it finished the cycle. It finished the cycle of the power of three. The power of three. But if we go into the 1 minute time frame, for the ones that don't believe, that believe that there's a lot of noise in the 1 minute, and this is what they teach you in the retail world, as there's a lot of noise in the 1 minute. You see over here we have the same thing. The price consolidates, accumulates traders, manipulates, expands, and then it does a reversal. And then from here, just finish the cycle again. And then we know why the price gets here and it comes here. And it comes here right in this point because it comes into this institutional tool. And then we know why it comes down here that lower to this minimum because we also know there's institutional tools there. So imagine knowing where the price is going to reach and where it's going to be, the direction it's going to go to with high precision too. So knowing the configurations of the algorithms based on the charts, it lets you be able to take trades with high efficiency trades that you could take in all the time frames. Either be in the 1 minute, the daily, the 1 hour. So for example, just to give you here, we have a tool, the fair value gap. So this is where we know where the price is gonna get here, and it's gonna get into the fair value gap and it start falling down. But as the price starts taking liquidity from the top because there's a ceiling, and then comes here, it takes the stop losses, and the ones that started to sell here takes out the stop losses, and then it takes out the stop losses, and it still has to take out the ones that were generating buys. So when the price comes in and to take out this and broke this ceiling, or even exclusive, it comes down to take the ones that bought here, and this is where the price comes down and takes them out. So as you know, there's high efficiency, high precision tools out there. So here you go, friends. So this is just a presentation to show the theory behind it, just to be able to help you know the context of what's going out there in the retail world. So you know there's tools, institutional tools that could help you take trades and take high precision trades. Just to give you an example here. This is a zone that a retail traders take, and this is accumulation. It's a zone here. And here's a tool that they take, and it's called the bearish block. And then our trades would have been in this form. As you can see here, it's high efficiency trades, and it's a high risk reward. It's a 1 to 9 risk reward, and it's a high precision trade. Our methodology used behind it, we call it SIA methodology. So what do we call it? SIA methodology. So because we gather from 3 methodologies that people use to see the views, we start extracting the tools, the tools out there with the most information out there, and we use it to be able to take the information out there. The S is from smart money concepts. The I is from institutional trading, and the A is from audio trading. Every one of each of them have different tools that work very high, good for high efficiency, but we've been able to extract what's best out of them because not all the information out there works. In smart money, it's a good strategy, but there's a lot of voids, a lot of emptiness that doesn't give you. It doesn't let you know the directional fractalical information. All they see is this. The price is gonna do this. It's gonna do a sweep and chug, and they're gonna start just waiting for the high interest point, so for them to start to take the sells. Not only is this, they start to take the order blocks. It's not only that. So for you to have a high trading, high efficiency, you have to take high precision. In institutional trading, they start to use the knowledge of the configuration of the charts. And then in the algo trading, we start to use the fractal configuration of the charts, the fractal configuration of the charts. And there's certain type of rules, and it's very good for you to be able to identify the moves of the price. This methodology helps you get 90 to 95% probability of winning the trades. If you apply the concepts well, if you did the homework, if you learned, if you're able to be, self-taught, you're able to get this percentage of trades, of winning trades. So if somebody out there tells you out there that they have an operational strategy that gives you 100%, run away from there, because in trading there's always going to be losses. But thanks to the methodology, SIA methodology, you're able to operate trades with a high ratio, right? Ratio, with a high risk reward ratio, and it helps you with a good risk reward. because we only take trades with a ratio of 1 to 3. 1 to 2 doesn't work to us. That 1 to 1 doesn't work to us. 1 to 3 works for us. That's the only trades we take. So why do I mention it very confidently? Because you're taking your trades. Because most of our trades is from 1 to 5, 1 to 10, 1 to 20. And this helps you a lot with your risk reward. Thank you, friends. This was the class today, which was like a theory class, is to help you understand how the markets work and how they work and what type of information that you should be looking out there to educate yourself. So here we have for you. It's up to you to if you want to educate yourself and learn with us and learn in our academy that's going to help you become a good trader. It's going to give you objective information, and this information we give it to you. We give it to you in a structure that's done step by step, and it's done like making it's like making a crossword puzzle. We start giving to you piece by piece, and we start giving it to you so you can start putting together the puzzle, and so you could become a profitable trader. Thank you, traders. I'm William, and Louis helping you with the translation. They helped us with the translation with the classes. Have a good night, and you could get in contact with us. You could start getting into constant communication with us with our Telegram. Thank you.